Good afternoon, everybody. This is Carmen Rojas here with Rojas Consulting. This is the fourth of our four-part series on finance for entrepreneurs. I have had the extreme pleasure of working with Stephanie Sims on this, and so we'll let her say hello, Stephanie.
Hey Carmen, I can't believe it's already over, but it's been such a pleasure to work with you, and I am so excited that we get to talk about venture capital today.
Absolutely. So just to kind of recap this lovely trip that we've been on, our first episode we were talking about personal finance and budgeting. How do you get your own personal house in order and creating budgets for your business? The second part we talked about crowdsourcing and crowdfunding and how do you use that to help start your business. The third part was last week. We were talking about credit and debt. And then, of course, today we are joined by Mr. Bobby Turan from Wasabi Ventures, and he's going to talk with us about venture capital. So we've covered those four areas throughout. We'll make sure that we post links if you missed any of our prior episodes and want to have access to those things. You'll be able to see them there. So real quick, though, I do want to send a humongous thanks to Mr. Dennis Deuce, who created these beautiful overlays for us that you're seeing there. If you ever have any need for your own overlay for your HOA or any assistance building and producing your HOA, Stephanie and I have both worked very close with Dennis, and so we think he's awesome. So go ahead and seek out Dennis for that. Okay? All right, so let's get started talking about venture capital. And one of the things that I just kind of want to jump in with, we've seen the TV shows, we've seen Shark Tank, and there's kind of like this whole new breed of interest in venture capital. And, you know, I know I have on my Twitter feed, I don't know how many a day I get on so-and-so company who just got their first seed round funded by so-and-so, and it's become kind of like the hot thing. So could you, Bobby, explain, first introduce yourself, and then the first question I want to ask is for you to just kind of explain the truth behind what is venture capital and how does it work for entrepreneurs?
Sure. So thanks for having me here, Carmen. So hello, everyone. I'm Bobby. I'm a venture partner with an early stage venture capital firm called Wasabi Ventures. And I'm hoping that I can help in any way that I can with just everyone's understanding about venture capital. Sorry, Carmen, what was the question exactly that you had asked?
Okay. So tell us, what's the truth about venture capital? Like, how does it really work? What does it do for entrepreneurs?
Sure. So, I mean, in order for businesses to get started, they typically tend to require resources to get going. The resources are usually human resources, so you need people who can help you. You need some time, so time resources. And then it always helps to have a little bit of capital. You know, there are lots of expressions like you need money to make money or whatever you want to say, I guess, but the industry of venture capital primarily is investors who are investing private capital primarily into ventures or new business efforts and usually the scenario is that the investor will believe that there is some ROI down the road, and by investing in this company early on, they take a piece of ownership in return for the capital which they give that entrepreneur. And so in the future, they'll be able to get some kind of a return on that investment when the company either gets acquired by a larger company or in rare instances, the company files for a public offering. So I think at a high level, that's what venture capital is. I think to your point, you mentioned that you hear a lot about venture capital financing nowadays. For the last several years, there's been a real boom around internet startups. So I think that's one thing to keep in mind is that venture capital doesn't necessarily only apply to internet or software companies, but most venture capital firms will have a specific sector which they like to focus on. And lastly, to what you mentioned about reading about them every day, you have to, as an entrepreneur, you have to keep in mind that all that glitters isn't gold, and of course the media only wants to focus on success stories. So they want to say, this company raised X millions of dollars, or this company got acquired by X, Y, Z. And what they never really talk about is how many companies every day go out of business. So it's just important to keep the reality sort of in mind.
Yeah. Well, and that brings up an interesting question, Bobby. for me, as we talk about this kind of mediatization of it's so great to have venture capital, I think maybe people have a little bit of a wonky perception of what it means to get venture capital funding. So you talked about the fact that it means that you share the ownership, right? So there's somebody else who's going to take a piece of the pie when you eventually get your payday. But what are some of the other aspects of venture capital investments that entrepreneurs need to think about? I'm thinking specifically in terms of, reporting, needing to meet with you guys and involve you in decisions. That may be something that we're not used to as entrepreneurs. Where it's not just I get the money and then I don't have to do anything. There are some obligations that come with it. So maybe you can tell us a little about those.
Yeah, absolutely. So I think the key word you used there was obligation. And maybe we can take a step back and go back to Carmen's first question. So as an entrepreneur, at a high level, there are really two different ways that you can go when you start a business. You can do what's called bootstrapping your own business, which is you rely on your own bank account and the money of very close friends or family. And typically when an entrepreneur is bootstrapping a company, he or she does not take a salary, and instead, so they sacrifice their time or their sweat, and they put the money that they have towards marketing or paying an engineer to actually build the software or whatever. The other route is that you take outside capital. So you basically take on someone else's money and say, hey, look, I've got a great idea. I'm the guy or the gal for the job because I have these credentials. Why don't you give me some capital? It will allow me to pay myself, and I can focus just full-time on this. A lot of times when an entrepreneur is bootstrapping, they may have to do something else to help pay the bills. And of course, it's important for that entrepreneur to be focused. So when you bootstrap a company, you can control your own fate. You can work on it. You can decide that it's not really going as quickly as you like. Maybe it's a seasonal business, and for the low season, you can sort of put it off to the side, work on other things. When the season starts again, you can go back. And, you sort of have the ability to do whatever you would like to do. When you take on someone else's financing, or in this case, you bring on venture capital, that raises the expectations that you're going to be able to get to whatever you've promised that investor to give you the money in the first place. So it creates a sense of real obligation on the part of the entrepreneur to hit milestones which, quite frankly, may be very difficult. Most people, when they start a company, startups are based on tons of assumptions, and of course, no one has a crystal ball. So naturally, lots of things go wrong along the way. And if you make a promise to someone and then you get started and you realize that the road to where you're trying to get is a lot rockier than you thought, well, that might put additional pressure on you as an entrepreneur to make maybe some dicey decisions, just because you're only now thinking about, rather than trying to build a great business, I'm just trying to get a return on my investor's capital. So I think that's really the key thing that entrepreneurs need to understand, is that that money is not by any means meant to be a golden ticket. It is meant to be sort of a boost, but that boost comes with the fact that there are greater expectations of what you can do with that capital.
Okay. Next question I have is related to that. So if an entrepreneur does attract a venture capitalist and they go through the process, which we'll talk about in a second, of getting funded and money exchanges hands, if I'm hearing you correctly, that's not it. They haven't arrived, that's not the finish line, so to speak.
That's absolutely true. And in fact, I would argue that if you want to use the metaphor of the finish line, once you take on that capital, the finish line is now necessarily further away. Because before, when you're bootstrapping, you want to talk about like economics, like numbers. Let's say you have $10,000 and you believe that there's an opportunity to make $100,000 in 1 year. So that's 10 times return on your money in 1 year, and you have the control of that. Now, if that opportunity you believe is worth $1 million, and you go to a venture capitalist and say, well, hey, give me $500,000, that venture capitalist is only going to invest if they believe that you can get them the return of, let's say, $5 million. So that's now created new challenges for you and a new sort of endpoint. So again, raising the money almost always means that the finish line is now a little bit further away.
Cool. And so what do you think is probably the biggest reason why they don't reach that end finish line? So, I've heard different rates on, people that do get venture capital funding and the failure and success rate there. What do you think is kind of the biggest, contributing factor to those that succeed after they get venture capital funding and those that fall short?
Yeah, it's a good question, and I know that lots of VCs and entrepreneurs wish they had the answer. I think the sort of the hard truth is that in most cases it's luck. Things just tend to work out. If you want to look at sort of the sobering statistics, venture capital as an industry is declining. In the last 20 years, as an alternative asset class, it's underperformed hedge funds and other forms of private equity, different forms of private equity investment vehicles. And within a venture capital portfolio, so that is the set of investments in companies that a VC makes, is called the portfolio of the company. The rule of thumb is that 50% of those companies you're going to lose your money on. They're going to completely fail. 3 or 4 of those companies you will just get your money back. And in one of those cases, you will generate a return. Now, from the VC's perspective, so that's 1 in 10 companies is actually going to make them money. And the people who are investing are typically very smart. They typically have domain expertise. These are the VCs. And to get to those 10 companies, they have to literally sift through hundreds of pitches from really talented entrepreneurs. So I think, again, the reality is that the success rate in starting your own business is low. And to your point, raising capital doesn't necessarily increase your chances in an absolute way. It may increase your chances in a relative way. So if there are 3 companies trying to develop a new set of socks for dogs, the one company that gets the venture capital probably has a better chance because they can afford to do more marketing, they can afford to hire more experts on dogs, they can hire a PR specialist to get the word out. But it doesn't mean that that is necessarily a good business or that it will succeed just because it's brought on the capital. So.
Well, and that's an interesting point, Bobby. I think that because what you do when you invest, when you get venture capital money, is you actually bring people into your team. Could you tell us a little bit about how important it is to pick the right person? For example, I think sometimes what I've seen is that the reason that venture capital doesn't work out for an entrepreneur is not necessarily because of a bad idea, but it might be because they are not aligned. Their expectations as an entrepreneur are not lining up with what the venture capitalist expectations are. And so when really crunch time comes and you've got to make a decision about what to do, they can't agree. So is there a way as an entrepreneur we can kind of find a better match if venture capital is the way for us to go?
Yeah, I think so. You're absolutely right that it's important for there to be a personal match, or rather, I think it's very important that there be a personal match between the entrepreneurs and the people who have invested in the company. I think that it's also important as you think about the stage at which venture capitalists invest. Some venture capitalists invest in the very early stages of a company when it's first raising money, when it's first trying to push its product out there. At that point, very little has been proven, a lot is based on assumptions, and there's probably very little traction to go off of. So what that investor is ultimately investing in is that entrepreneur or that team of entrepreneurs. And so for that reason, it's very important that there be a connection, because chances are the entrepreneur is going to look to that investor for introductions to people who can help them go a little bit faster. It's going to look for feedback. It's going to look for advice on how to avoid common pitfalls. Wasabi Ventures, the firm that I work for, specializes in that early stage investment. So you always hear the general partners say, we invest in great people. And that's really the thesis of the firm. We're looking for great entrepreneurs. At the later stage, you have companies that will raise, if a company, like when you read about a company like Uber has raised $400 million or whatever it might be. At that point, the company is definitely not a startup anymore. It's already generating lots of revenues. It has maybe hundreds of employees. The people who are writing those checks are not really investing in the team as much anymore. They're investing in a proven business, and that's more like growth capital rather than pure venture capital. it's not really a venture at that point. It's sort of a proven thing, and those investors just want to help it grow. So, but again, back to your initial point, what will always matter is that you want there to be a good fit between what you and your investor are both sort of hoping for as far as an outcome. And I think a common mistake that people who are raising money for the first time make is that they will go out and they will talk to absolutely anyone who's an investor. And I think that's okay, because you got to get the word out, and you never know. Maybe someone will write you a check, and that's all you need. Maybe you're the expert in what you're doing, and there's no one who will know better than you. But since that's rarely the case, what's more important, and if you want to have a higher success rate, is before you reach out to people, you should try to understand, okay, what other kind of companies has this person invested in? What is their background? Did they study engineering in college, or what did they study finance? Should I come at it with more of a business perspective or more of a technology perspective? And just like anything else, it's a sale. You as an entrepreneur need to sell your business at the later stages, and at the early stages, you really have to sell yourself. You sell that, I'm the person who can help you get a big return on your investment. So match is definitely very important.
Well, and since it's someone that's going to be with you until you exit, which can be anywhere from 3 to 7 years or longer, it needs to be somebody that you feel comfortable communicating with, right? I mean, because to me, that's one of the places I see things break down as well, is as an entrepreneur, things start to go wrong. And instead of saying, this person is on my team and they want to help me, the immediate reaction is, oh, I can't tell them. I have to pretend everything's okay because I don't want them to know it's bad. So maybe are there some, I don't want to say maturity issues, but are there some things personally as an entrepreneur that we need to ask ourselves before we invest with a venture capitalist? Because if that's where we are, I think then maybe we just can eliminate venture capital as an option for us. If we don't want to share that kind of information or have that kind of conversation.
Yeah, I mean, things will go wrong. I guarantee you, whatever your business is, things will go wrong. And again, back to match, I think good investors and anyone who's a venture capitalist as their profession, like they do it professionally, they go to an office that is a VC firm in a building, they know that things will go wrong. They get it. The decision of whether, and so a follow-on point on that is that, so again, at the early stages, we talked about the importance of the people and how, no one has a crystal ball. There are a lot of assumptions. I would sort of pose that question, I would sort of word your question in a different way. Is that a common question that I get asked is a lot of the times is, what are investors looking for in my financials? Do they want the numbers to just, explode in year 3? Is it in year 4 or 5? How much do I need to make at least $1 million by year 2, or am I dead? Do I need to break even by year 5? The reality is I've never seen a financial projection that doesn't go up and to the right. They all look like that, folks. Everyone does that, so don't worry about that. But at the early stages, especially if you're raising money and you don't have any sales, any investor who's worth taking investor from will realize that your projections basically amount to nothing. You can't predict, again, like I said, things will go wrong, but the problem is that you just don't know what will go wrong, and you don't know when they're going to go wrong. If you knew that, then it would be sort of inconsequential that they go wrong, because you'd be ready. But you just don't know, and since you always, in a startup, have a finite amount of resources and time, it's really important to just have a very open discussion with whoever you're talking to. Yeah, I think that, having said that, there are a lot of cases where investors are looking for an entrepreneur who's very confident. They definitely want to create that sense in most instances that, I know something that you don't know. So I'm the expert on, like, for example, for you, Stephanie, like, you are an expert in finance. If an investor is talking to you and you have a startup that's in the world of finance, they're going to trust that you probably know something from your experience that they don't know about how things will work out. And it's ultimately that sense that they get that they're going to place a bet on, not necessarily your idea or your projections, financial projections, or anything like that. So.
Just one thing, though, we're talking about assumptions, and I think you're right that there's a huge role to be played by how confident you are, by how knowledgeable you are about your market, and how well you explain that. But I do think you can't shoot yourself in the foot. right? I think your financials, while they're going to look like a hockey stick, they can't be too crazy at the beginning. If somebody's looking at what's reasonable, how could we look at what's reasonable right out of the gate?
I don't want to confuse things too much, but there's a very interesting, so before I started working with Wasabi Ventures as a venture partner, I was an entrepreneur out of college. We started an e-commerce business. We sold that business. Our investors made money, and then I went on to work on the investment side. And when I was raising money, there was this interesting phenomenon where you're right that investors don't want numbers that are too unreasonable, but if your numbers are small, investors similarly will probably be disinterested because they think to themselves, well, why would I risk my capital, like $50,000, $100,000, when I could just have it sit in the bank, put it towards my kids going to college or something? I want to invest in something where I'll put down $100,000 and I'm going to make $1 million in 3 years, or I'm going to make $500,000 in 2 years, 1.5 years or something. So you have to sort of walk a fine line between what is reasonable and what is going to seem attractive to an investor. It's impossible for me to say across all businesses what's reasonable because every industry and market is different and has different sort of factors in it. I would say, though, that no investor is expecting you to break even within the first 2 months of operation. I remember one time I saw a pitch where the entrepreneur quoted, I was looking at their financials, and they said, we're going to break even in 8 weeks from the time that we raise capital, which made me wonder why they would need to raise capital. And then 6 months later, we're going to be cash flow positive. And I said, my reaction to them was, well, great, guys, but you're not trying to raise much money. Why wouldn't you just try to round that money up from your friends and family or put it on credit cards or something? Like, you don't need venture capital financing for what you're trying to do. Now, at the same time, I didn't really believe in the business, so that was just sort of anecdotal advice. But I guess it goes back to your point where, you need to be reasonable in how you present yourself and confident. But at the same time, investors, especially right now that they see these companies getting acquired for tens, hundreds of millions of dollars, and even in some cases billions of dollars, they want to invest in that pie in the sky opportunity because most investors at the early stage realize that giving an entrepreneur a check, again, remember, only 1 in 10 is going to succeed. It's basically like them burning that money. I mean, if you really look at it, the chance of return is very, very small. So.
Well, I just want to take a quick second here and acknowledge a few people who are in our audience, and they're asking some really great questions over here. Roy Montero, hey Roy, how's everything going? Glad that you're listening in. And Dr. Christopher Vogelman, I know he's asking a few questions as well as planning on watching us in Replay City. It's when you don't have time necessarily to be fully invested live, you go back to Replay City and watch it again. So hello everyone, thank you so much for watching the show. And I wanted to just kind of recap a little bit, with Christopher's questions. Some of these I think we've kind of touched on a bit. So we've talked about kind of the ratios and the timelines and all of that. But one thing that Dr. Vogelman is asking is the 5-year time horizon the maximum that a VC would consider in order to invest? Could you answer that for me, Bobby?
So just to clarify, does that mean that a VC is looking to get their return in 5 years or less?
I think that's what he's asking. And just reading kind of some of his prior questions, I believe he's trying to kind of timeline it out. And what I was going to ask, if you would go back just a little bit further and start at the very beginning, from when I'm an entrepreneur and I think I have a great idea and I want to get venture funding. What's the process? And just go ahead and describe it in the most rosiest of lights.
Okay. Thanks for that question, Dr. Vogelman. I would say that your horizon is not that far off. I think most VCs are looking for return on their capital, but it's usually in the range of like 6 to 8 years. And the reason is because venture capitalists typically invest other people's money, so they have to close a fund, right? They'll have a certain amount of time where they can make investments, and they need to receive a particular return on that investment, and then they close that fund and they move on. If they're successful, they can reinvest that capital in a new fund, open a new fund, and continue on from there. We can sort of talk about the specifics about how venture capital funds are formed too, if you'd like. But to Carmen's question, so I have an idea, and I decide that based on my projections, I'm going to need $500,000 to get my venture up and off the ground. At that point, chances are that very little has been proven with the business model. So that money is really experimentation capital. A lot of times investors will invest in those type of companies because they either have domain expertise or because they really believe in an entrepreneur and they want to be able to be a part of the entrepreneur's future ventures. There's a lot of loyalty in the investor-entrepreneur community. So I raised $500,000 from a syndicate or like a group of angel investors, which are distinct from venture capitalists because angels typically invest their own capital, whereas venture capitalists invest from a fund, which is a pool of other people's capital. Okay? So I raised the 500K, I hit my projections, my investors are happy, and we realize that we're going to need more capital. So I go for what's called my Series A round of capital. In the Series A round, I raised $2 million. Okay? I raised that $2 million, I hit my goals. Let's say that that's 12 to 18 months out from the first time that I raised the capital. Okay? And again, I hit my milestones. Again, everyone's happy. If everything's been going smoothly, typically what you see is in that next round, which is called the Series B, you'll see a big jump in the amount of capital they raise. So it'll go $500,000, $2 million, and then $10 million, let's say, for example. And the idea is that by the time you go from that Series A to that Series B, you've really nailed down your business model, your differentiator, those two key things. And now it's all about, as quickly as possible, we want to make this business get as big as it can. And the reason you do that is because you want to try to threaten an incumbent player in that market space who hopefully has some cash that they're sitting on who can acquire you. And they try to, and you try to get an acquisition to happen for something like $40 million, let's say. The typical, to talk about like some specific numbers, the standard angel investment in America is $18,000. That's per angel. And the standard software exit in America is about $30 million. And that average is obviously ratcheted up a lot by companies like Nest that gets acquired by Google for $3 billion. And it's kept low by a lot of companies that are acquired for less than $10 million. But it's about $30 million. So that gives you a sense. Now let's just take an example and assume that you don't exit the company. After you take that $10 million, you realize that you're like, okay, I could sell the company, but this is sort of where you get to that question of do I build it or do I buy it, or build it or sell it. You say, okay, rather than selling my company, my next round of financing, I'm going to raise $60 million, and I'm just going to take out the person who would acquire me. I'm just going to take them out of business. And so the person would then raise $60 million, let's say, or $40 million, or whatever. At that point, once the company's taken on, let's say, $70 or $80 million, there are fewer and so the thing you got to keep in mind is that as you take on more and more capital, again, as you think of obligations or expectations, as you take on more and more capital, there are greater and greater expectations of your investors for a particular type of return. So once you've taken on like $80 million, there are only so many companies out there that have $80 million in cash that is just slushing around that they can, sort of invest or put into a company. So what might then happen is that the company would apply for a public offering, IPO, and become a public company and raise money from public markets. So that's just sort of a timeline of from startup to potential acquisition to potential IPO.
That's really cool. And I have a quick comment from Dr. Vogelman, who he says, if there are angel investors, are there devil investors too? And you gotta love Christopher Vogelman because he can be a bit cheeky at times. But in good faith to his question, it sounds like there are investment, be they angel or VCs that would make good fits, and some that maybe do not. So if there were, to speak for someone who has been an entrepreneur and is now sat on the other side of the table, are there maybe red flags that we should look for as this is not going to be a good partner for us?
Yeah, I mean, I think that a good entrepreneur, in my mind, has, first and foremost, has good intuitions. And if you're sitting across from someone and you get an uneasy feeling from them and you think that they're going to be a pain, they're going to always be interrupting you, they're going to constantly, whatever, bother you with questions or waste your time, you probably don't want to take their money. Angels is obviously just, as you mentioned, is just a term. Angel investors can refer to a dentist, a doctor, a real estate developer, your parents, anyone who is not an institutional investor are called angels.
So I guess the question that I have is, and we've talked about it quite a bit, the match notion, but I think we ought to address this idea that you need to position yourself when you go in to talk to somebody. And as someone who's either never been through a funding round or maybe only asked for a loan at the bank, what are the things that we could do as entrepreneurs that would really help us either stand out from the crowd or make the best impression while not completely going hat in hand and saying, like you mentioned earlier, oh, if you'll give me money, I'll do whatever you want. How do we find that happy medium? And is it a personality thing, or is it something that we can actually develop?
Yeah. So it's a couple of things. I think that, first of all, investors want to invest in something that's going to make them money. They are, they're business people. If you have a great idea for a nonprofit, that's fine, but you need to go find an organization that will write you a grant or something, because VCs and angels are probably, and that's where sort of the term angel gets because your parents could invest in something that's not going to necessarily make them money, or your uncle could, or whatever, your rich cousin. But professional investors are going to want to invest in things that are going to make them cash in return. So that's important. And so from that perspective, you should have a clear understanding of how am I going to take your money and turn it into more money. It doesn't need to be immediate, but you need to at least have a sense of how am I going to get there. Again, back to what I said, anyone who's really worth taking an investment from will get that you don't have all the answers. And it's okay to not have all the answers. One way that I would encourage you to not position yourself is that you have all the answers, because what investors do not like to invest in typically are entrepreneurs who seem uncoachable. Okay? You want to demonstrate a level of coachability. That's important. Anyone who's going to give you their money needs you to feel comfortable taking their advice. You don't need to follow it to the letter of whatever they say, but you at least have to be open and consider what they tell you, just out of courtesy, right? I mean, that's just manners. The other thing that I would say is that typically the investment decision always comes down to a handful of 3 to 5 fundamental questions. It's like, how will you make money? How are you different from your competitors? How can you protect what you're doing? Why are you the best person to run this company? And how does this company grow in your mind? What are the key elements? A lot of times entrepreneurs will present to me with a beautiful presentation, a beautiful pitch deck. If I meet them in person, they'll comb their hair, they'll get a haircut, they'll put on a suit and tie. But when you start to ask them just the very basic questions, they'll start to trip up. And as an investor, and that's just the ultimate red flag. Now, if you answer all those questions and you go through the due diligence process and it just doesn't feel like it's going anywhere, that's different. But I think as far as how you position yourself, it's important to be confident in what you're doing, but it's most important to have done your homework and make sure that you can answer those basic questions.
Well, and I like that, again, it's this balance that we're talking about, but the notion that you're not coachable, I think is probably the hardest part as an entrepreneur. I can speak for myself, because it's your baby, right? You get there and you're like, but don't you see how great this is? But how can you not love this as much as I do?
Right. Sure.
But is there something that we could focus on? Maybe, I mean, the five points I think is really great. Could we maybe create the story part about why we love it so much and let that be our passion? And then once we get past that part in the presentation, focus more on these 5 questions that you've given us, so we feel like we've shown our passion, but it doesn't permeate everything we do?
Yeah, I mean, I would say that you got to kind of look at it realistically. The chances of success in a startup are very low. And there are going to be setbacks. The chance that you will succeed no matter who you are it's like depressingly low. It's in the single-digit percentage points. But of course, if you can really succeed, that's something that's fantastic. That can be huge. It can change your life. It can change the life of others. So that's what's so, that's what drives a lot of entrepreneurs. Passion is definitely the key thing that most investors are looking for. Because if you're not passionate, when things start to get really crummy, which again they definitely will, you're going to want to throw in the towel. So they're going to want to know that even when things start to get really tough, even if they can throw every possible negative scenario at you, as long as you can maintain your composure and maintain a sense of like level-headedness, that's the type of person who I want to invest in as an investor, and investors want to invest in. So I think that's really important. And in terms of how you best present yourself, again, I think showing the passion and I think a good way to show the passion is to talk about your team and show why you're a good fit and why you're passionate, how your past experiences sort of breed that passion. But as quickly as possible, you should just come right out and explain, how is this going to be a business? Because that will be the first question any serious investor will ask. And if you went through an entire pitch and the person says, yes, I want to invest, and they never ask you how it's going to make money, and you don't tell them, and they're sort of like, they don't really ask any questions, that would be an example maybe of a devil investor, or someone that's, as an entrepreneur, should be a red flag to you that you may not, something about that is just probably too good to be true, so, or whatever that's worth.
Those are great points. And just real quick to clarify something that I heard you mentioning before. So as you're going through your rounds of funding, so say for example we go through the first round, and part of my VC funding was that Wasabi Ventures has 10% equity, and then we do well as a company, and now I'm moving on to the next round. I'm still taking so now I have 90% to offer. Right? So every time I go through a round, I'm giving away a little piece of equity, correct?
A piece. It's not necessarily little. Could be a lot.
True. True. But I'm giving away a piece of equity every round I go through. So I think I saw someone had an infographic or something like that of at the very end, by the time a company gets to an IPO stage, the original owners may only own like 30 or 40% of the equity. The rest of it is kind of diced up between maybe other people that were helping with the founding of it, or venture capitals or whatever, that the actual owners, the original owners, may only have 30-40% left.
Yeah, it's just a question of value, guys. Would you rather have 100% of something that's worth $1 million, or 1% of something that's worth $1 billion? It's just that's what you got to ask yourself. It's do you want the whole grape or a slice of a watermelon, right? So. You got to be, I mean, when you're raising money and you're not making money as a company, you have to be ready to give up some ownership in your company. Otherwise, no one's going to invest. What are they investing in, really? What do they get in return for their money? So.
Right. One question that Christopher Vogelman, I think he's getting like a private tutorial out here, but that's okay. We're more than happy to do it. He asked, is there a magic number of slides in a pitch deck? 5 to 7. He said, death by PowerPoint can be painful. And yes, it can. I know it can. But just real quick before you answer, I wanted to ask your opinion. It's directly tied to this. There is a YouTube video that Guy Kawasaki has done and all of that about pitching to VCs. And he has, the 10-20-30 rule and some other things in there. Do you agree with those? I mean, and not necessarily to ask you to disagree with Guy Kawasaki, but, would you recommend that be a good place for people to look?
Yeah, I mean, as far as the ideal number of slides, to Dr. Vogelman's question, I would say 10 or fewer slides is whoever that entrepreneur is probably is doing a very succinct job of explaining their business. Someone like Guy Kawasaki is just such an outlier. I mean, but I think what's key about what he's saying is that you should just be very clear in what it is that you're saying, and that most investors are probably not that interested in a bunch of embellishments. You shouldn't try to pretend to be something you're not, because everyone will see right through that. If you really try to paint this picture of, oh, we don't need to raise the money, then they're probably, the first thing that investor's going to think was, well, then why are you here? If you don't need my money, then, I know you need my money, that's why we're here. Now explain to me why you think it's a good idea for me to give you my money, this particular amount of money, why are you the right person for it? So I think rules like 10, 20, 30 have only between 5 to 10 slides. Those are good like sort of guidelines to make sure that you as an entrepreneur do a very clear job of explaining your business. It's unlikely that the business with 5 PowerPoint slides is going to be less fundable than the company with 6 PowerPoint slides. That's just, chances are that the meat was like in a sentence or two. You didn't need that many slides to begin with. So I would say the key is to keep it short. The things that they're most interested in, again, are sort of who is your team, what traction do you have, what have you done to prove that this is a good idea, and how is this going to make money?
Very interesting. And just so people can understand what the 10, 20, 30 rule is, and I'll put a link up to the YouTube video, but the 10, 20, 30 rule, if I'm not mistaken, it was 10 slides, 20 minutes is how long your presentation should be, and your font should be 30-point font, I believe was the 10, 20, 30 rule. So if we won't go into detail and all that. We'll post a link, but just so people understand what we're talking about, that's Guy Kawasaki's 10, 20, 30 rule for pitching investors.
If I can say one thing quickly, I mean, it's kind of like a lot of people will see Steve Jobs or Jeff Bezos give a keynote. Jeff Bezos is the CEO of Amazon, and I think most people know who Steve Jobs is. And when Steve Jobs gives a keynote, he comes out and there's this beautiful big screen, and it's just a picture of an iPhone, and it just says the word iPhone. And that's incredibly powerful. But that's incredibly powerful because it's Steve Jobs and it's Apple. It's not because he used a certain font size or an image, right? It's because the concept is so strong and it's so pure. So that, again, the emphasis should always be on sort of clarity, and that's why that's valuable.
Well, and I'm sorry, I real quick, I'm going to interrupt. I think one of the things that is important for people to understand is, it's funny because I remember when I was working on my MBA, I had to give a presentation in class, and I put my PowerPoint slide together, and I didn't have every word that I was going to say in the PowerPoint because I hate that. I personally can't stand it when people read their PowerPoints verbatim. Maybe it's just a personal, thing with me, but I hate it. So I didn't do it. And my professor actually, knocked me down a few points on my final grade for that because he said, we didn't put everything up there. So just in contrary to what you might, have learned in business school, the real world says we don't want to see every word that comes out of your mouth to be on the PowerPoint slide. So, make sure that your points are there and be succinct and direct and clear. But you don't need to put every single word that you're going to say on the slide.
Right, that's right.
So, Stephanie, take it away.
Okay, so we've been talking about what happens when you get in front of a potential investor. That's kind of what we're calling the pitch phase, right? We're talking about what do your slides need to look like, what do you need to say, how do you need to present yourself. But I think maybe there's a lot of info out there about that because clearly it feels like a high-stress situation. But I'm wondering if we shouldn't talk a little bit about how you make the initial contact. First off, how do you pick the right people? Who are you going to approach? And then what do you send them? Because I've seen people say you should only send a 3-line email, and if they're interested, then they'll respond to you. And then I've seen other people who are like, no, you need to send them a nice presentation folder with your entire info memorandum in it to make sure they talk to you. So can you help us situate how we take the initial contact and what we should tell people just to get them interested? Sure.
So I think in the last couple of years, there are a couple of resources that have come out which are free that are very helpful. One of them is called AngelList. Most investors who want to invest in particularly tech companies are on AngelList. It's kind of like a LinkedIn for investors and startups. So there's two sides to it. There's the entrepreneurs and the startups, and then there's the investors. And you can showcase their, how much you're raising. You can include screenshots, whatever. It's a great way to sort of get your name out there like I said, pretty much any investor who has any clout or who has a real network around them will have an AngelList profile. Right? It's pretty standard. As far as sending people anything, just to state the obvious, you don't want to mail anyone anything. Email only, digital transfer. Keeping it short and sweet is definitely good advice. I think that a couple lines in a simple email are enough. It's very helpful to use LinkedIn. Oh, well, before I get to that, it's a few lines in an email, and then what's commonly referred to as a deck, which is just a PowerPoint presentation. So again, back to what we said, only a few slides long. If that piques the investor's interest, you can be sure that they're going to get in touch with you and try to set up a follow-up discussion. And when they do that, they'll let you know exactly what they're looking for. Okay, now we want to see financials. Now we want to see. You don't need to include a full P&L in your introductory slide deck. That's probably not necessary. As far as how you make contact with investors, another common sort of rule of thumb is that most investors want an introduction from someone who they know within their network. And the best way to find who's in an investor's network who's also in your network is to just find that person on LinkedIn. Reaching out to an investor cold may work. There are some investors like TK, for example, the general partner of Wasabi Ventures, who is just sort of maniacal when it comes to responding to emails. He doesn't not respond to emails, so if you email him, he will respond to you, whoever you are, whatever your idea is. But I would say that TK is like 0.01% of an already really small pool. Most investors will not respond to you, especially if you shoot them a cold email, just because they get hundreds of emails a day, and that's people who are emailing them on top of the responsibilities they already have to have for their board seats or their existing portfolio companies. So definitely the best approach would be identify an investor by doing your research on a site like AngelList. Look for a mutual contact or a point of introduction. Maybe you're an alumni of the same school where that investor went to school, something like that. Look for a warm introduction into that investor, and then when you make that introduction, a few sentences. Hey, so-and-so investor, my name is XYZ, I'm an entrepreneur, my company is called this, maybe include a link to your site if it's live already. Here's what we do in one sentence, not more than that. And I've attached a slide deck to just sort of walk you through everything. That's just the standard way, and again, chances are you're going to have to do that to quite a few investors before you really get some good discussions going, but I would say that that's a standard procedure.
Okay, thank you. I mean, I think that's helpful for people who are just starting out. And the follow-up for me is, how long should you allot for the process? Because I think a lot of times, and this is an entrepreneurial thing, I'm sure you know this, people are like, but I need the money in 2 months. But I'm going to run out next week. Venture capital clearly is not an option for somebody who can't make it through the end of the month. But when we're thinking about it as an option, should we plan to spend 6 months getting an investment? Is it going to take us a year? What kind of timeline should we plan so that we can really get through the process and give ourselves the best chance?
It's tough to say. It always takes much longer than you expect. I can say that as a general rule, unfortunately. I think an extremely fast round of fundraising from the time that you open the round, which means that you've started raising money, to when you close the round, which means that you've raised the total amount that you were looking to raise. If a company could start and then close around in 8 weeks, that would be lightning quick. Of course, it depends on how much money you're trying to raise, the stage of your company. There are tons of variables here. But I would say that if you're trying to raise your first round of capital, let's say up to $1 million, you should allot yourself 4.5 to 6 months from the very first email that you send out until that last check has actually been deposited. Because another thing that I sort of had to learn the hard way is that a lot of times you'll have a lot of good discussions, good follow-up. You'll sort of dance with the person for 2 months even, and then at the last second they'll just say, you know what, we have to pass. And you might feel like that's a lot of time that you wasted. I guess a mistake would be that if let's say you're trying to raise $1 million, one person has said, I'll give $250,000, and you dance with them, dance, and then they back out, and because you spent so much time on them, you didn't really have any other people to sort of, you might sort of leave yourself in a tough position. So My philosophy is always be opportunistic, talk to as many people as possible, and it's going to take time. So you need to be patient. The other thing to keep in mind, though, that's really important, and this is something that a lot of investors look for when they think about a savvy entrepreneur, is that it's typically the job of the CEO of a company to raise money, right? CEOs have primarily three jobs, traditionally: raise capital, hire great people, and maintain the overall vision of the company. So when you're raising money, that's a full-time job. And the time that you spend raising your money is going to be time that you necessarily can't spend building your business. So you got to keep in mind, if it's going to take you 6 months, but that means that for 6 months you're going to always have basically a side job, is that worth it? So these are just some things to think about.
Time management there sounds like it would be an absolute key thing. Real quick, another question from our buddy, Dr. Vogelman. And this question is, since the SEC has yet to write the rules regarding crowdfunding, isn't that a dangerous road to travel down to that pot of gold? And I'm not sure if he's also kind of referencing something we were maybe talking about earlier, but I would ask you to speak to, there's the idea that you cannot crowdfund for equity, I believe is what he's referring to at the SEC. So what's your opinion on that proposed idea of being able to use crowdfunding to raise equity? Or excuse me, you exchange equity in crowdfunding.
Yeah, my general philosophy as an entrepreneur, so I'm going to take off my investor hat for a minute and talk to you guys as an entrepreneur. My general philosophy would be take the money when you can get it. I don't suggest that you necessarily get in bed with someone who makes you feel uncomfortable or who you feel might be like a predator as an investor. But the reality is you're going to come across far fewer people who are trying to prey on your company than you're going to come across people who are ready to invest. Maybe I said that the wrong way. There's not going to be many people who are looking to prey on your company. I think it's good to be wary of that, but it's just not that common. Everyone's looking to make an investment. Everyone wants to invest in the next Facebook or Twitter. And like I said, you're going to have to fire 100 bullets before 2 or 3 get through, right, realistically. So because that takes so much time, because it is so distracting, you should just try to do whatever you can to raise money using Kickstarter or sites like AngelList, which allow crowdfunding. I mean, until the SEC has regulated it, I would encourage you to just go ahead. And in the event that you raise that money and then the SEC starts to crack down on it, those investors who are involved will find some way to sort of backtrack and protect you and also themselves. I mean, obviously they don't want their own money, anything to happen to that. So that would be my general advice regarding fundraising. Take what you can get. It's at the end of the day, I remember one time I came from a meeting and I said, my mentor asked me, said, how did the investment pitch go? I said, I think it went pretty well, but I don't really know if I like the guy or whatever. And my mentor said, it was an introduction from my mentor. He said, well, I mean, he really liked you. He wants to invest in the company. I said, yeah, I'm just having my doubts. And he said, look, at the end of the day, his money is green, right? And you need capital. Money is money. And if you need the money to hire someone or if you need the money to do a marketing campaign, you don't want to waste too much time trying to find the perfect match because it just may not be out there. So that's my general feedback.
Well, and I like that. Since I'm the one that was pushing the match, it's true. We don't want to go too far, right? I think the problem with this discussion is that it's very situation specific, right? I mean, there's a huge difference between someone who's looking to raise, $1 million Series A and someone who needs $25,000 to build a prototype. Those aren't the same things. And so, if you need the $25,000 to build a prototype, I think you're exactly right. Find the money wherever you can get it and get your proof of concept and move forward. But I guess as with your entrepreneur hat still on, what would you say is the number one reason that people get rejected? Like, as an entrepreneur, put yourself, you've done it, put yourself in the shoes of an entrepreneur and say, okay, what could I have done differently that would have helped me be more attractive to an investor? And then if there's any one thing that would really make someone jump out. We've talked about confidence. We've talked about having a great team. We've talked about clear vision. But, is there any one thing that really is going to make you head and shoulders above the others? So what's the thing to avoid, and what's the thing to do?
Yeah, I would say it's sort of two things which are very parallel. I think personality, presentation, all that stuff is important. If you have a rock solid way to make money and you've already been generating revenue, people will invest in you. It's not a popularity contest. At the end of the day, you're trying to raise money to build a business. The number one and two things and it's sort of different situations, that will make an investor not invest. Number one is they just don't believe in your business model. They're like, you can't make money. Maybe your deck looks nice. Maybe you're very smart. Maybe you've been a veterinarian for 30 years and you want to invent a new set of glasses for dogs because you think that's going to be really hot. If they just don't believe that that's going to sell, it doesn't really matter who you are because they're not just going to give you their money. The second big thing that you see a lot of, especially with internet companies, is that the market that you're chasing is just not big enough. Again, it's chances are that you'll fail, and it's a numbers game anyway. So if you're going to really put everything on the line and chase a market, at least chase a market that's $100 million in value, so that if you can capture just 5% of that market, you've got a nice $5 million business for yourself. So rather than chasing a market that's maybe only like $1 million, probably not going to be that interesting. So I would say it's either they don't believe in your business model, or they don't believe that the market opportunity is really big enough for them to tie up their capital in your startup.
Great. Well, we are almost at the end of the show, so I just have a quick final question for you, Bobby, and then we'll do our final shout-outs and our goodbyes. But the last question that I have is just kind of, if as an entrepreneur, that's now sat on both sides of the table, is there one piece of information that you wish you knew, that you know now, that you wish you knew when you got started?
There's lots. It's too bad it's the end of the show. We could have done a session just on that.
You can come back anytime.
Okay. When I started, I was sort of greeted with a lot of anecdotes of it's always going to take twice as long, it's going to be twice as expensive, it's going to be twice as hard. I think that the mistake that I have made, and I've seen a lot of my friends who are entrepreneurs make, is that it's easy to underestimate how difficult it is to build a successful business. And if you do it the right way as an entrepreneur, and by that I mean you give it everything you have, and you build it with love, and nothing can come between you and your business, and even when things are bad, you put on a happy face, and it doesn't work out, you just have to know that there are just so many reasons why it could have not worked out. You shouldn't take that the wrong way, personally. Contrary to what anyone might read in the papers, entrepreneurship is like building a startup is not a great way to get rich. A lot of people think like, oh, I'm going to make a startup. It's a gold rush. Like, whatever pizza delivery apps are being bought for $40 million. It's just, there have been thousands of that very app, and for some reason that one struck the gold. So just know that it's incredibly difficult, much more than anything you can imagine. But at the same time, I would sort of balance that with, as from what I see, I don't think that there can be a more rewarding career than being an entrepreneur, being your own boss, controlling your own destiny. That kind of stuff gets me really excited. And I know it excites most investors too, because a lot of them, most top VCs are former, highly successful entrepreneurs. And so they know that it's a lonely journey. They know that a lot of people are going to look at you weird when you do a startup or whatever, and they're going to wonder why you're doing that. But just pay them. My advice would be to pay them no mind, but just work hard, do your best, know that it's difficult for absolutely everyone, no matter who they are or whatever, who they've raised money from. It's tough, but it is rewarding. So I encourage you all to get out there and build great businesses.
That's great. Thank you so much. And I would ask you if anybody wants to get in touch with you, if they've got a deck or would like to ask your opinion about anything, is Google Plus the best place, or what's a good way for them to reach out to you?
Yeah, you can reach me directly at Bobby, B-O-B-B-Y, at wasabiventures.com. And I always do my best to respond to people. So I'm one of those investors that you don't You don't necessarily need a warm intro. Just shoot me a note, mention that you watched the show, and I'll be happy to help you out however I can.
That's great. Thank you so much. Well, folks, that is the end of our 4-part series. I know everybody cried, but this has been absolutely fantastic. This has been such a good time with Stephanie and all of our guests that we've had on. There have been just, too many of them for us to thank individually, but thank you guys. We appreciate all of this. So just as a reminder for what we're going to do with all of this, we are putting all of this content together into a bit of a comprehensive form, so you can get timestamps and the transcripts of all of these. All I need you to do is just send me a message. You can put it there in the events that just says, send me the book. It will be kind of a compiled form of all of this, so you'll get all of the good stuff about crowdfunding and budgeting and venture capital and credit and debt all in one nice, easy book. So that is the best way that we can make sure that this information lives on and that you can use this and have it at your fingertips always. So once again, thank you so much for watching. Stephanie, what's coming up next for you?
Oh my gosh, you put me on the spot. I've got Network Roundtable on Friday, every Friday, of course. Well, Dennis and I are there. We always look forward to seeing anybody. And then we're still working on getting Financeability up and running, and I would love anyone who's interested to swing by the site and give me your opinion. We're still in beta testing, so there's a survey you can fill out, or hit me up on G+. If you've got any kind of questions about finance, of course, I'm always willing to help you. And I just want to say a huge thank you to Bobby for joining us today, for all the information that you shared with us. And it was really a pleasure to meet you, so thanks so much.
That was my pleasure. Thanks for having me.
Okay, and as always, I'm here on Google+. I do spend maybe a little too much time on this site, but if you ever have any questions about digital marketing, entrepreneurship, and business, I'm always more than happy to help you out. I also do a lot of strategy work and things like that, so please do not hesitate. Hit me up here. I'm also available at carmen@rojasconsulting.net. And also, just to let you guys know, we will be coming back with our weekly HOA. I hesitate to call it Camel Jacket, and it's really funny because I'll have to tell that story another day, but TK was the one that I was looking for at an event, and he had his camel jacket on, so he's kind of the one that's behind it.
Well, I know that exact jacket that you're talking about, so that's funny.
Yeah, but so yeah, we might be doing a little bit of shifting around with the name. So we will be back next week. Next week I will be having on Craig Calvert, who is going to explain to us the psychology behind marketing. So hopefully you've enjoyed this series, but then we're going to go back more into the digital marketing and entrepreneurship phase. So look out for me and Stephanie. This is not going to be the last time we'll be together. We will be working together on projects going forward. So hopefully all of you that have enjoyed this will come back and enjoy us again in the future. But thank you to everyone. Have a great day, and we'll talk to you again soon.
Thanks.
Thanks.